Welcome back to the Deep Dive, everybody. Today we're diving into a topic that, well, let's face it, a lot of people find a little bit intimidating, life insurance.
Mhm.
But, it's one of those things that's super important to really wrap your head around. So to help us navigate this complex world, we've got a whole chapter here called Chi Un 4 Life Insurance Policy Types that really breaks it down.
Yeah, absolutely.
Our goal today is to give you a clear understanding of the main types of life insurance policies out there, what they are, how they work, and when you might want to consider them. We want to make sure you can cut through the jargon and really understand the key differences.
Exactly. So, whether you're just starting to think about life insurance or you already have a policy and just want to make sure you really get it, this deep dive should give you a good foundation.
For sure. Now, the chapter lays out a whole bunch of different policies, from basic to more intricate.
Right.
So let's just jump right in and start with what's probably the most straightforward type term, life insurance.
Term life is, it's often seen as the simplest form of life insurance. It's kind of like renting financial protection.
Okay.
You pay for coverage for a specific period, the term, and if you pass away during that time, the policy pays out a death benefit to your beneficiary. If the term ends and you're still alive, the coverage just stops.
So basically, if you outlive the term, you don't get anything back, but it's cheaper up front. Is that the main appeal?
Well, the lower initial cost is definitely a big draw for a lot of people, but term life also offers a lot of flexibility.
Oh, okay. Like what?
Well, for example, many term policies have options to renew your coverage or even convert it to a permanent policy down the road without having to go through a new medical exam.
Oh, I see. That could be helpful if your health changes, right?
Exactly. And term life often makes a lot of sense if you have temporary financial obligations, things like a mortgage or a car loan that you want to make sure are covered if something happens to you.
Makes sense. So the chapter goes into some different flavors of term life, like level term.
Level term is pretty easy to grasp.
Okay.
It means the death benefit stays the same throughout the whole policy term. And your premiums, the amount you pay, usually stay level too. So like say you have a 20-year level term policy for $250,000.
Right.
If you die anytime within those 20 years, your beneficiary gets the full $250,000. It's very predictable.
Nice and simple. Then there's increasing term, where the coverage actually goes up over time.
Right. With increasing term, the death benefit grows, often at set intervals or by a percentage each year. The chapter gives an example of a policy that increases by $100,000 every 5 years.
Wow.
This kind of policy could be good if you expect your income to go up a lot or if you want your coverage to try and keep up with inflation.
That makes sense. So then I guess decreasing term's the opposite, where it goes down.
Exactly. With decreasing term, the death benefit gradually gets smaller over the policy's term, while your premiums usually stay level. This type is often used for things like mortgage protection.
Ah, because your mortgage balance goes down over time, too.
Precisely. As you pay off your mortgage, you need less coverage. So the decreasing term policy aligns with that. It's even sometimes called mortgage redemption insurance or mortgage protection insurance.
Makes sense. So it's like a safety net that shrinks as you pay off your debt.
Mhm.
The chapter also mentions credit life insurance. What's that all about?
Credit life insurance is a specific kind of decreasing term insurance that's tied to a loan. So say you take out a loan for a car or maybe a personal loan.
Yeah.
The lender might offer you credit life insurance. Basically, if you die before the loan is paid off, the insurance pays the remaining balance to the lender.
So the lender is the beneficiary in that case.
Exactly. The maximum benefit you can get with credit life insurance is whatever's left on the loan.
I see. But I mean, can they make you buy it?
No, that's a really important point the chapter highlights. Lenders can't force you to buy credit life insurance from them as a condition of getting the loan.
Oh, good.
They might suggest it, but you have the right to shop around and choose your own insurer if you want.
Glad to hear that. Now, let's say you start with term life because it's affordable and meets your needs now, but you think you might want permanent coverage down the line. That's where convertible term comes in, right?
Yes, absolutely. Convertible term policies give you the option to switch to a permanent life insurance policy, like whole life, without having to go through a new medical exam.
Oh, that's really helpful, especially if your health takes a turn for the worse.
Exactly. It gives you peace of mind knowing that you can lock in permanent coverage even if you become uninsurable later on.
So how does that conversion process actually work? I saw something about attained age and original age conversions.
Yeah, so the difference lies in how the premium for that new permanent policy is calculated.
Okay.
With attained age conversion, the premium is based on your age when you convert, which will be older than when you initially got the term policy, so it'll likely be a higher premium.
Right.
But with original age conversion, the premium is calculated as if you had bought the permanent policy at your younger age when you first got the term policy, so the premium would be lower.
Gotcha.
But to get that lower premium, you usually have to pay a lump sum to make up for the difference in premiums you would have paid over the years, plus interest.
So it's like catching up on what you missed.
Exactly. The chapter mentions that most conversions actually use the attained age method, though.
Makes sense.
Hmm.
I guess people might not have that lump sum sitting around.
Uh-huh.
There's also this thing called interim term, right?
Yep. Interim term is basically a super short-term policy that also has that option to convert to permanent coverage. It's meant to give you immediate protection while you're sorting out your longer-term insurance needs.
So it's like a temporary placeholder.
Exactly. It usually converts to permanent within a year.
Okay.
The temporary premium is usually based on your original age, but when you convert, the permanent premium will be based on your attained age at that point.
Gotcha. Now, all these term policies eventually come to an end unless you convert them. What happens when your term is up?
Well, with renewable term policies, you can extend the coverage for another term without needing a new medical exam.
Okay, but I'm guessing it gets more expensive.
You're right. The premiums will go up each time you renew because they're based on your age at that time. It's called a step-up premium.
Ah, makes sense.
The simplest form of this is annually renewable term RT, or YRT for short. It renews every single year, and the premium increases with each renewal.
Gotcha.
And these policies often show you both the current premium and the maximum it's guaranteed to reach.
Good to know.
Then there's reentry term. It gives you a chance to maybe get a lower premium when you renew.
Well, that sounds good.
But the catch is you have to prove you're still in good health with a new medical exam. So you can always renew at the regular higher rate without the exam, but if you pass the exam, you might qualify for a lower premium.
Okay, so it's like a reward for staying healthy.
Exactly. But if your health's declined, you can still renew, just probably at a higher premium than the best rate they offer.
Makes sense.
So to sum up term policies, the death benefit can be level, increasing, or decreasing. The premiums are usually fixed at the start, but they'll likely go up if you renew or convert. And term life generally doesn't build any cash value, so there are no policy loans, withdrawals, or surrender charges to worry about.
Gotcha. So it's all about pure protection for a set period.
Yeah.
But what if you want coverage that lasts your whole life? That's where permanent life insurance comes in, right?
Exactly. And the most common type of permanent life insurance is whole life. Think of it as a financial foundation for the long haul.
Okay.
Whole life insurance is designed to provide coverage for your entire life, and the death benefit will be paid out no matter when you pass away. It also builds cash value over time, like a savings account that grows on a tax-deferred basis.
Oh, so it's not just about the death benefit. It's also like an investment.
Right. You're essentially building equity within the policy. Whole life is also known as straight life, continuous premium life, or ordinary life insurance. And it's typically structured to mature or reach its endowment at age 100. That means the cash value is supposed to equal the death benefit by then.
Okay.
So you've got the death benefit protection and this growing cash value component that you can actually tap into during your lifetime if you need to through policy loans.
Oh, okay. So like you could borrow against it?
Yeah, you could, but keep in mind that policy loans do accrue interest.
Gotcha.
And the cash value itself usually isn't paid out to your beneficiary on top of the death benefit unless you add a specific rider to the policy.
Right.
So there are a lot of moving parts with whole life.
It sounds like it.
Yeah.
So what are the main things that affect how fast that cash value grows?
Well, several factors play a role.
Okay.
The face amount, the death benefit, is a big one. Policies with higher death benefits usually build cash value faster.
Right.
The amount and duration of your premium payments also matter. Shorter payment periods or higher premium amounts can lead to quicker cash value growth during that payment phase.
I see.
And of course, the longer the policy's been in force, the more time that cash values have to grow.
Right.
So, like any investment, time is on your side.
Time and compound interest.
Exactly. You mentioned whole life maturing at age 100.
Yeah.
Historically, that was the standard.
Uh-huh.
But now, some insurers are using older ages for maturity.
Oh, okay.
But the main idea is still the same. The cash value should eventually equal the death benefit.
Gotcha. And with whole life, the premiums are usually fixed, right?
Yes, that's one of the key features. The premiums are calculated based on your age when you buy the policy and are designed to stay the same until you hit that maturity age, usually 100 or older now, depending on the insurer.
So it's predictable, which is nice.
Yeah. Right. But the chapter also points out that whole life premiums are often bundled, meaning the insurer doesn't have to break down exactly how much of your premium goes to things like covering the death benefit, their expenses, and growing the cash value.
Oh, interesting.
So it's not always super transparent.
Okay.
But within whole life, you have different options for how you pay those fixed premiums.
Yeah.
You've got straight whole life, limited pay whole life, and single premium whole life.
Right. So with straight whole life, you just pay those fixed premiums for your whole life
Mm-hmm.
until you die or hit the maturity age.
Yeah, that's the most basic type. Then there's limited pay whole life, where you pay premiums for a set period, like 10 years, 20 years, or until a certain age, like 65, and after that, you don't have to pay any more premiums.
But the coverage continues.
Yeah, the coverage keeps going, and the policy still matures at the regular age.
So it's like you're prepaying for the coverage.
In a way, yes.
Yeah.
And since you're cramming those premiums into a shorter time, the initial premiums will be higher, but the cash value tends to grow faster during that payment phase.
Gotcha.
And then there's single premium whole life, where you pay one big lump sum up front, and then the policy's fully paid up.
That must be a pretty hefty payment.
It is. It's the most expensive up front,
Yeah.
but it could end up being the cheapest overall in the long run.
Interesting.
And you start building cash value right away because that whole premium is working for you from day one.
Okay, so to summarize basic whole life, the death benefits level, the premiums are either fixed for life or paid in a single lump sum, and there's cash value that grows in a predictable, tax-deferred way. And you can usually get policy loans.
Exactly.
With straight whole life and limited pay, there are usually no surrender charges if you cancel the policy, but with single premium, you might have to pay surrender charges, especially early on.
Right. Now, beyond these basic types, there are also some non-traditional whole life options. These are variations that often tweak the premium structure or other features to try and make whole life more accessible to different people.
Okay, I'm intrigued. What are some examples?
Well, there's modified whole life, where the premium is lower in the initial years and then jumps up to a higher level that stays fixed for the rest of the policy.
Okay, so it's easier to get into at the beginning.
Exactly. It could be good for someone who expects their income to go up in the future.
I see.
Then there's graded premium whole life. It's similar to modified, but instead of one big jump in premium, the premiums increase gradually over a set period and then level off at a higher rate than straight whole life.
So it's more of a gradual climb.
Right. And then there are some interesting variations like enhanced whole life, sometimes called economatic or extraordinary life.
Those sound fancy.
Yeah, they usually have low premiums and might pay dividends. But the unique thing is the death benefit actually goes down each year. Yeah, but the dividends the policy pays out are then used to buy either additional coverage to boost the death benefit back up or one-year term insurance to make up the difference. So the goal is to keep the death benefit stable, even though it starts out lower.
Oh, okay.
It's kind of a balancing act.
I see. What about indeterminate premium whole life? That sounds kind of unpredictable.
It can be. So you start with low premiums for a certain period, and then the insurer can adjust them based on how well they're doing with investments, mortality rates, and expenses.
So you could end up paying more down the line.
Yeah, but there's always a maximum premium stated in the policy that they can't go above. So you
Better.
get the potential for lower premiums if things go well for the company, but you also have some protection from huge increases.
Okay, that makes sense.
Huh.
What about current assumption whole life? That sounds like it's tied to what's happening in the economy.
It is. It's also called interest-sensitive whole life. Both the premiums and the cash value can fluctuate based on the insurer's assumptions about things like interest rates, death rates, and expenses. If those assumptions are more favorable, you might end up paying lower premiums or seeing faster cash value growth.
So it's a bit of a gamble.
In a way, yes, but there's usually a guaranteed minimum cash value in return and a maximum premium.
Right.
Some policies even let you withdraw some of the accumulated interest without penalty. These can be structured with low initial premiums, or you can pay higher premiums to potentially pay off the policy faster.
Okay, I see. What about indexed whole life?
Indexed whole life is designed to try and keep the death benefit in line with inflation.
Oh, interesting.
The death benefit can increase based on an index like the CPI, which measures changes in the cost of living.
Okay.
Sometimes you, the policyholder, bear the risk of premium increases if the index goes up a lot, but sometimes the insurer builds those expectations into the initial premium. And there's often a cap on how much the death benefit can increase each year.
Gotcha. So it's designed to protect you from losing purchasing power over time. And finally, equity index whole life. That sounds a bit like investing in the stock market.
It does, but it's more indirect.
Okay.
The interest credited to the cash value is linked to the performance of a stock market index, like the S&P 500.
Likely.
But there's also a guaranteed minimum interest rate, so you're protected if the market tanks.
Yeah.
The idea is to give you some of the potential for growth that comes with the stock market, but with less risk.
Makes sense. Wow, that's a lot of variations on whole life.
It is. There are a lot of options out there.
So now the chapter goes into what it calls alternative, non-traditional life insurance products, starting with adjustable life. This one sounds like it gives you a lot of control.
Yeah, adjustable life lets you tweak both the coverage amount and the premium payments. So if you decide to change the death benefit, your premium for the next year will adjust accordingly. But if you want to increase the coverage, you'll probably need to prove you're still healthy. It's basically whole life with a customizable death benefit.
I like the flexibility.
And then there's universal life, which takes that flexibility even further.
Okay.
You can adjust the coverage amount, the premium payments, and even how often you pay. It's also interest sensitive, so the cash value earns a variable interest rate, usually with a guaranteed minimum.
Oh.
And one of the big selling points of universal life is that the premium structure is unbundled, meaning you can see exactly how your premium payments are being allocated to the different parts of the policy.
So it's more transparent.
Exactly.
I like that. But I guess with all that flexibility comes more responsibility.
That's a good point. You have to be more hands-on with managing a universal life policy because you have more control over the premiums. If you don't pay enough, the costs will start eating into the cash value, and the policy could even lapse.
Yikes.
So it's not a set it and forget it kind of policy.
Gotcha. Now, the chapter mentions two death benefit options with universal life. Option A and option B. What's the difference?
Option A, also called option 1, gives you a level death benefit. As the cash value grows, the net amount at risk, the difference between the death benefit and the cash value, goes down.
Okay.
But with option B, or option 2, the death benefit actually increases over time because it includes both the face amount and the cash value.
So the death benefit keeps growing alongside the cash value.
Exactly.
Interesting.
And universal life policies have to follow specific tax rules to make sure they're considered life insurance for tax purposes.
Oh, right.
There has to be a certain minimum gap between the death benefit and the cash value. If the cash value gets too close to the death benefit, the policy could lose its favorable tax treatment.
Gotcha. I see the chapter mentions some riders you can add to universal life policies, like a waiver of monthly deduction and a no-lapse guarantee. What are those?
The waiver of monthly deduction rider basically kicks in if you become disabled. The insurer will usually waive the part of your premium that covers the policy's expenses while you're disabled.
So we don't have to worry about the policy lapsing if you can't work,
Right.
and the no-lapse guarantee.
That prevents the policy from lapsing even if the cash value can't cover the monthly deductions, as long as you've been paying at least a minimum premium. It's an extra layer of protection.
Good to know. Now, there's this thing called indexed universal life, or IUL.
IUL lets you allocate your cash value between a fixed interest account and accounts that are linked to the performance of a stock market index like the S&P 500. So you have the potential for higher returns, but it's generally less risky than investing directly in the stock market because it's tied to an index.
Okay.
And the cash value still grows tax deferred.
Sounds like a good balance between growth and stability. And what about guaranteed universal life?
Guaranteed universal life is all about providing a guaranteed death benefit, usually for life, as long as you keep paying the minimum premium. Even if the cash value drops to zero, the death benefit is still there.
So the focus is really on the death benefit guarantee.
Exactly.
And finally, there's survivorship universal life, which covers two people, right?
Yeah, it's also called second to die insurance. It covers two people, usually a couple, and the death benefit is paid out only when the second person dies.
Okay.
Because the payout is delayed, the premiums are typically lower than buying two separate policies. It's often used in estate planning to help cover things like estate taxes.
Interesting. Okay, so we've covered adjustable life, which is customizable, universal life, which is super flexible, and then all these variations with different features and guarantees. Now the chapter shifts gears and starts talking about SEC-regulated life insurance policies. Sounds like we're getting into more complex territory.
We are. These types of policies involve investments in securities, so they fall under the oversight of the Securities and Exchange Commission. Agents who sell these products need both a life insurance license and a securities license.
So it's like a hybrid between insurance and investing.
Exactly.
Okay, so what's variable life all about?
Variable life, or VL, is permanent insurance with fixed premiums and a guaranteed minimum death benefit. But the key difference is that the cash value is invested in separate accounts that hold things like stocks, bonds, and mutual funds.
So the cash value can go up and down with the market.
Right.
That's a bit riskier than traditional whole life.
It is. There's no guaranteed interest rate or minimum cash value beyond the death benefit floor, so you could potentially lose money.
I see.
It's generally for people who are comfortable with market risk and want more control over how their cash value is invested. They're hoping for higher returns than what you typically get with whole life.
Makes sense.
Yeah.
And then there's variable universal life, or VUL.
VUL combines features of both variable life and universal life. It gives you flexible premiums, a death benefit with a guaranteed minimum, and the option to invest your cash value in separate accounts.
Oh, wow.
It's like the ultimate in flexibility, but it also comes with the most risk. You also have the option to take partial withdrawals from the cash value, which you usually can't do with regular variable life.
Okay, so to recap, variable life has fixed premiums, but variable cash value and potentially a variable death benefit, while VUL adds flexibility to the premiums as well. And both are regulated by the SEC because of the investment component.
Exactly. Now, let's move on to some more specialized types of life insurance that are geared towards specific needs.
Okay, what's first?
Family joint life policies. They cover 2 or more people, typically family members, and the death benefit is paid out when the first person dies.
So it's like a first-to-die policy.
Exactly. And the surviving people on the policy often have the option to buy their own individual policies without a medical exam after the first death. The premiums for a joint policy are usually lower than buying separate policies for everyone.
Makes sense. And then there are joint life and survivor policies, which I think are also called second-to-die policies.
Right.
These cover 2 or more people too, but the death benefit isn't paid until the last person dies.
Exactly.
These are often used in estate planning.
Right. Yes, they can help cover things like estate taxes after both spouses have passed away, and the premiums are usually lower than buying separate policies.
Gotcha. What about family plan policies?
Those are designed to cover a whole family under one policy.
Okay.
They usually provide whole life coverage on the main income earner and then add term riders for the spouse and kids.
Oh, okay.
And the coverage for the kids is often convertible to permanent coverage later on, and new kids are often automatically included. So it's a way to bundle everyone together.
Makes sense. Then there are family income policies. These sound like they're meant to provide income replacement.
That's the idea. They combine whole life with decreasing term insurance.
Okay.
If the insured person dies within a certain period after the policy starts, the beneficiary gets regular income payments for the rest of that period on top of the whole life death benefit. But if the insured person dies after that period, they just get the whole life death benefit.
I see. So it's designed to help the family make ends meet for a specific time. And then family maintenance policies are similar.
They're similar, but they use level term insurance instead of decreasing term. And the income payments start from the date of death and run for a set number of years.
Okay.
And at the end of that income period, the beneficiary also gets the whole life death benefit. So it's like getting 2 payouts, regular income, and then a lump sum at the end.
Gotcha. Now, the chapter also talks about juvenile insurance, which is just life insurance for a minor.
Right.
But there's this thing called jumping juvenile insurance. It sounds kind of interesting.
Jumping juvenile insurance, or an estate builder policy, is designed to have the death benefit increase a lot, often by 5 times when the child reaches a certain age, like 18 or 21.
Wow.
And this increase happens automatically without a medical exam or a premium increase. It's a way to get a lot of coverage for a child as they become an adult at a low price.
That's pretty cool. Now we're getting into the other life insurance products section, starting with endowments. Those sound a bit different from traditional life insurance.
They are. Endowments are designed so that the cash value grows really fast and reaches the face amount by a specific date, which is before age 100. If you die during that time, the policy pays out the death benefit.
Okay.
But if you live to the end of the endowment period, You get the face amount as a living benefit.
Oh, interesting.
Because of that rapid cash value growth, the premiums are usually quite high. And they're less common these days because of tax law changes.
Gotcha. And then there are modified endowment contracts, or MECs.
MECs aren't a specific type of policy, but rather a tax classification.
Okay.
If you put too much money into a whole life policy too quickly, the IRS might classify it as a MEC, and that changes how withdrawals and loans are taxed.
So there are tax implications.
Right.
It's basically to prevent people from using life insurance primarily as a tax shelter.
Exactly.
What about industrial life insurance? That sounds kind of old school.
It is.
It's those policies with small coverage amounts and premiums that were traditionally collected door to door.
Yep, that's the one. They were often marketed as burial insurance.
Gotcha.
They're less common now, but there's a modern version called monthly debit ordinary life insurance, which offers higher coverage amounts and monthly premiums.
Okay. I see there's also face amount plus cash value policies. What are those?
Those pay out both the face amount and the cash value when you die.
Oh, wow.
But the premiums are super high because you're essentially getting double the payout.
Makes sense. And then there's accidental death and dismemberment, or AD&D.
AD&D isn't really life insurance in the traditional sense. It only pays out if you die from an accident or if you lose a limb, your eyesight, speech, or hearing due to an accident.
Okay.
It doesn't cover death from illness or natural causes.
Gotcha. What about non-medical life insurance?
That's where you don't have to take a medical exam to qualify, but the premiums are usually higher to compensate for the increased risk to the insurer.
Makes sense.
They still look at your health history, though.
Okay.
And then there's minimum deposit life insurance. It's not really a type of policy, but rather a strategy for using policy loans to help pay the premiums.
Okay.
It's usually used by high-income folks, and there are specific tax rules around it.
Gotcha. And finally, there's the distinction between participating and non-participating policies.
Participating policies, which are usually issued by mutual companies, can pay dividends to policyholders if the company does well financially. Non-participating policies, typically from stock companies, don't pay dividends.
Okay. So with participating policies, you might get some money back.
You might, yeah.
It's like sharing in the company's profits.
Mm.
The chapter ends with a discussion of stranger-owned life insurance, or STUGLI, and investor-owned life insurance, or IOLI.
These are basically schemes where someone with no real connection to you takes out a life insurance policy on you hoping to profit when you die.
Oh, that sounds shady.
Yeah, it's generally illegal in most places because it violates the principle of insurable interest. You have to have a legitimate financial or family relationship with the person you're insuring.
So it's like gambling on someone's life.
Basically, yeah.
Yeah.
And it's important to distinguish these schemes from legitimate life settlement contracts where someone who already owns a policy sells it to someone else.
Okay, good to know. Well, that was a whirlwind tour of life insurance policy types, from simple term life to super complex variable universal life and everything in between.
It's a lot to take in, for sure.
The big takeaway for me is that there are so many different ways to protect yourself and your loved ones financially.